why don't we all three pop up on the stage? Because the idea of this first session is to focus on ESG and capital markets. So I think we have about 40 minutes, maybe slightly less than that. So the way we're going to do this, the three of us will give presentations to start with, short presentations, just to do a bit of scene setting for you. And then if we have some time left in our allotted 40 minutes, we'll just open the floor to Q&A. So kind of as you're hearing our presentations, think of challenging questions, particularly for Corey and Sven, who I'm sure will be delighted to take them. So maybe if we could kick off with my slides. And if you can just zoom right into the next one, if that's okay. So I'm going to focus on, I guess, an area where there's been a lot of academic work from the economics, finance profession over the last decade or so now, thinking about links between planetary health and the health of the economy and the financial system in big picture terms. And a lot of that work is focused on the risks dimension. So as we have a warming planet and experience climate risks and biodiversity loss, what does that mean for the economy, the global economy and the financial system? If you could jump to the next slide for me. Oh, thank you. So I'm going to start with a framework for thinking about categorizing these risks that some of you may have come across before, but I think it's a useful way of just getting our heads around some of these issues and how they can manifest. So the idea is to distinguish in big picture terms between the physical risks of climate change and the transition risks. So what do I mean by those terms if you haven't heard them before? By physical risks, I mean the direct impairments of asset values, hits to cash flows that are going to come with climate change and biodiversity loss. It's useful to kind of go a step further here, because we're capturing two distinct issues with that term. So let's think about the events we see every summer on our screen. So wildfires, extreme storms, flooding, these types of events. Let's think of those as the acute manifestations of climate change. There's also the kind of slower burn issue in the background, so the chronic risks that come with rising temperatures year by year, rising sea levels. And these pose related but distinct risks to businesses, to cash flows, and so on. So that's physical risks, and I'll say a little bit more about that in a second. The second dimension is transition risk. So here the idea is there are threats to business models, to cash flows, to asset values, again, from the shift from our current economy and economic system to a low-carbon economy. The most natural way of thinking about that is through government regulations, or sometimes the catch-all term carbon pricing or carbon taxing is used to capture the idea that, as the governments tighten the screws, some business models just won't be viable anymore. But we should also recognize this can come from shifts in consumer preferences, from shifts in technology as well. So I'm going to basically, in my presentation, I'll delve into these two issues a little bit and give you a bit more color on what they mean. So let's start with physical risks. And I've just got a little table here where I'm going to highlight some of the ways in which these physical manifestations of climate change can have an economic impact. What are the transmission channels through which we can see an economic effect? Now, the most obvious and direct channel, I think, is to real estate values, and that's going to matter for all of you here today. So real estate, obviously, a lot of the value is location-specific. So it follows immediately from that if there's an acute physical risk event, that's going to have an impact on real estate values. And we've seen that already in the data. I think another very obvious channel is to the insurance sector and the reinsurance sector. So to the extent that insurers are either suffering very large losses, unexpected losses from some of these events, or actually withdrawing coverage, or providing it at a price that's just not economically affordable any longer, that's going to have knock-on effects through the financial system. I'll come back to those two kind of obvious channels, I think, in a second. But just to mention a couple of others, you could also think there are potential corporate defaults that could flow from climate change. We've seen some of these events in the United States, big electricity companies being sued, basically, for faulty faulty cabling causing wildfires, so that type of channel. Now, of course, if there are losses on real estate and losses hitting corporates and corporate defaults, that's going to flow back to the banking system, either through collateral values or just outright loan defaults. So we'll see a link back to banks. So there's a lot of economists worry that we could see a rerun of what happened in 2008, where some of these things could lead to a banking crisis. And then there's less data here on the last two things I'll mention, but I think it's reasonable that there could be an issue here. So also we could see higher government risk, government bond risk, particularly local governments where a lot of the tax revenue is kind of locally based, or just generally a more volatile macroeconomic environments. The types of events we've lived through over the last 18 months with high and volatile inflation, people worry that this could be a more endemic part of the landscape from here. Those issues are relatively well understood. I think less well understood is what the loss of biodiversity might mean for the economic system. So people worry about the effects that natural disasters could have on the food industry. They also worry about the effects on the pharmaceutical industry in terms of reduced capacity for natural product drug discovery. So there are these types of channels that we still need to know more about, I think. Let me say a little bit more about the real estate side and then the insurance side, because I think these are particularly relevant for all of you. On the real estate side, I think the obvious risk really is that we're just not pricing climate risks adequately. They're not captured in current real estate valuations. And there is a recent paper in Nature Climate Change that does a kind of a bottom-up analysis for the United States and found that the underpricing is potentially quite dramatic, particularly around coastal areas where valuations are much higher. So the threat here is we could see a correction in asset values as we become more aware of these risks, I'd say. On the insurance side, I think the issue is just we're seeing rising insurance losses year by year. Some of that reflects an increased prevalence of these climate risk events. It also just reflects higher insured values, basically. Mm-hmm. But what we're seeing from insurance companies is less of a desire to insure properties or big jumps in premium. Now, of course, that's going to have a knock-on effect. So if you think about how could a revaluation of real estate occur, it could be that you just can't insure the properties any longer. So that's the feedback loop I think we have in mind. And if there is a loss of coverage of this sort, that's basically putting risks back to households, to banks, ultimately to governments around the world. All right, let me say a word or two about transition risks, then I'll close. So the same sort of thing, we can think about, what are the financial manifestations of transition risk. Basically, what people worry about is there could be a big correction in asset values again. An extreme version of that is called stranded assets, where assets that are currently productive and have years ahead of them in terms of economic life could suddenly see their value drop to zero if a certain regulation comes in place or a carbon tax is put in place. There's also the potential for legal risk here, I think, for companies that are either viewed as contributing directly to climate change or greenwashing, in effect, misleading their customers. And the same sort of thing, maybe in the interest of time I won't go through these, but we can also think about biodiversity transition risks. I'll end with a couple of final points. So there's quite a lot of academic research that tries to ask the question, are these climate risks actually being priced in financial markets right now? So there's a well-known study that looks at US-listed companies, and it finds that carbon emissions are actually priced. So over and above all the other factors that investors care about, they're also requiring greater returns from companies that have higher emissions, which is very interesting, I think. So this suggests the potential for transition risk could be a systemic risk for the financial system. And then I'll end on real estate, and I think this ties to perhaps something Sven will talk about as well. So there are studies out there that say, well, real estate in particular as a sector is particularly vulnerable to transition risk. It accounts for a little over a third of measured emissions, according to McKinsey. That includes both the construction of the building in the first place and the kind of ongoing usage of the building. And there are estimates out there that suggest you've got trillions of dollars worth of potentially stranded assets. But I'm sure you're going to talk more about that. So I'm going to hand over to Corey, I think, at this stage, and then we'll take your questions.
Thank you, David. We good? Good morning. My name is Corey Walrod. I'm with the ISSB technical staff. I'm an economist, chartered financial analyst. I specialize in energy finance, business development, treasury corporate finance. I've come here today to provide a little bit of perspective on how the capital markets look at these types of risks that we've already discussed this morning, that direct physical transition risks that basically all businesses face. And in the context of the markets themselves, clearly they are pricing in these risks. The question is, are the markets really transparent enough for them to price it accurately? So fundamentally, the work that the ISSB does, the International Sustainability Standards Board, part of the IFRS Foundation, is to try to develop a set of sustainability-related disclosure standards that provide that information, that transparency in the marketplace. Now, just cast your mind back about 5 years ago, almost exactly 5 years ago, in 2019 to 2020, remember the Australian wildfires, how bad those fires were. Coming from the oil and gas background, I had friends in Exxon who were asking themselves, what's really the future for our industry given what's going on in Australia today? So the leadership of companies across the globe started to recognize that there are a lot of risks that were not being appropriately priced into the capital markets. At the end of 2020, the IFRS Foundation trustees went out and sought public comment as to the role they should play in the development of sustainability-related disclosures in this context. And the feedback that they got was really overwhelming, particularly from the capital markets themselves, the investor. There was a very loud clarion call that they wanted the IFRS to step in and try to achieve some of these goals that are listed here in terms of converging the alphabet soup of voluntary initiatives that had been developed over the years. Basically bringing decision-useful, comparable, and material information to the marketplace to adequately price that risk. And ultimately, from the preparer side, making sure that it's cost-effective. In other words, creating that convergence so that preparers don't have to report to multiple standards across multiple jurisdictions. So the IFRS Foundation basically established the ISSB to lead that effort, and that basically was announced at COP26 in November of 2021. Now, the ISSB is subject to the same rigorous due process that the IASB, the International Accounting Standards Board, is subject to. It's a very transparent process, and it really relies on consultation. So the folks in this room have access to the IFRS, both the IASB and the ISSB, to have a word in terms of how these standards are being developed. These are called consultation periods, public comment periods, which happen periodically. We had one just prior to the issuance of IFRS S1, General Requirements, and IFRS S2, Climate-Related Disclosures, summer of last year. In terms of the first goal, rationalizing the standards, the IFRS basically established the ISSB to converge really the top tier of frameworks that were already out there. The Climate Disclosure Standards Board, Integrated Reporting, SASB, as well as adopting the TCFD recommendations, which is now part of the IFRS stewardship as of this year. Converging those standards and trying to create a single standard that can be used globally. We also signed an MOU in spring of 2022 with the GRI. Now keep in mind the GRI has a much broader remit than the ISSB. The ISSB is focused strictly on the investor, providing that information to the investor that they need. GRI has a much broader remit, which is sometimes called impact or double materiality. We also, of course, started working with EFRAG, the European Commission's European Financial Reporting Advisory Group, as they began to develop ESRS. And of course, CDP later in 2022 basically adopted IFRS S2 in its questionnaire as of this year, in fact. So the ISSB is striving to provide that global leadership to create that convergence of standards. What's our goal? Again, going back, very simple. Decision useful, comparable information for the investor. But at the same time, we are also very mindful of the preparers. We don't want to create a set of standards that's not cost effective. So if you have a chance to look at IFRS S1, S2, you'll find that there are a lot of transition measures. There's proportionality measures there. We recommend the use of reasonable and supportable information. We recognize that this reporting environment is relatively immature, not just in this industry, but across all industries. And so we understand that initially it's going to be basically the capacity building that we talked about earlier this morning with Mark, developing that knowledge within organizations, how to actually do this reporting and be mindful of it is just really getting started. But I would encourage you to also cast your mind back. The risks and opportunities that every business faces and has faced for years are the ones that you manage. Those are your sustainability risks and opportunities, typically. You're mindful of them already. It's just you haven't provided public disclosure, and so the capital markets are unaware of your activities. Now, the ISSB provides essentially a bridging between the traditional financial reporting that's been developed by the IASB and FASB in the United States, and of course the broader sustainability-related disclosure frameworks like GRI. But the ISSB is focused strictly on the sustainability-related disclosure standards that allow the management of your company to tell its story. This is not about compliance. This is not about public relations. This is really telling the capital markets how you are managing the risks and opportunities that you're facing from day to day. One of the first steps in IFRS S1 is doing a materiality assessment. Our definition of materiality is identical to the IASB's definition of materiality. So the materiality assessment that's done by your financial team and your management every year is exactly the same one, exactly the same standard that the IFRS has adopted for the ISSB. And our ultimate goal here, and it's, again, we're just getting started down this road. There's still a lot of bifurcation in the reporting landscape, is to create a global baseline of investor decision-useful material information. A global baseline that is comparable across companies, industries, as well as jurisdictions across the entire globe. Now, there can be layers on top of that. Individual jurisdictions may have additional pieces that they want to layer on top of that global baseline. But it will really create a common language across the globe as jurisdictions begin to adopt these standards. Now, keep in mind, the IFRS does not mandate these disclosures. We develop them in coordination and in cooperation with the regulators, the jurisdictions. It's really the jurisdictions that put these standards in place. And we are essentially a marketplace for the ideas that come in, trying to capture the best practices for that reporting. And the last point I wanted to basically touch upon here is in terms of the ISSB due process and governance. The IFRS Foundation trustees represent regulators, they represent preparers, investors. Basically, the trustees are answerable to this IFRS Foundation monitoring board. That monitoring board consists of the International Organization of Securities Commission's board as well as one of their committees. It consists of the U.S. Securities and Exchange Commission, the UK's FCA, the European Commission, the Ministry of Finance of China, the Financial Services Authority of Japan, and the equivalents in Korea and Brazil. So basically, these trustees are answerable to the securities commissions around the world to create transparent standards in consultation with all appropriate stakeholders. That means the preparers, the investors, as well as the jurisdictions and the regulators. Now, below them sit the International Accounting Standards Board, which has been in place since 2001, and it's been quite successful in terms of its adoption globally. It's really done a lot in terms of creating that comparable set of financial standards around the world. That is the goal of the International Sustainability Standards Board with our sustainability-related disclosures. But keep in mind, the IASB was standing on the shoulders of giants. The financial standards took roughly about 100 years to develop, give or take. We simply don't have that long in terms of the sustainability-related disclosures. We're trying to put them in place as fast as we can. So we can't accept just simply an evolutionary process to winnow out what the best practices are. We actually need a lot of consultation with both preparers and investors to identify what is the information that they need. Now that consultation I talked about in 2020 with the IFRS Foundation, the investors came out and said climate first. That was their main focus in terms of risk, but not climate only. They were seeking basically a set of standards that were industry-based, industry-specific, because every industry faces a unique manifestation of these sustainability-related risks and exposures. They're just different from industry to industry. At the same time, they want to make sure that the sustainability-related disclosures are comparable across jurisdictions. That's a little bit more difficult needle to thread. Interoperability is going to be a continuing challenge over the next few years. Luckily, we've got some help. The consultative groups that advise the ISSB consist basically of all the stakeholders you can imagine, where the jurisdictional working group is basically all the jurisdictions around the world in a single room being led by an ISSB member, Sue Lloyd, our vice chair, to try to come to a point of convergence, again, to rationalize the fractured landscape of reporting. The Sustainability Standards Advisory Forum, again, it consists of accounting professionals as well as jurisdictional representation. They actually have a say in terms of what we're looking at, our agenda priorities, our technical work plan, as well as the IFRS Advisory Council, which is a much larger council, basically spanning the entire globe in terms of geographic diversity as well as industrial diversity. You've got the Investor Advisory Group, which basically is our institutional investor group. They have a huge voice in determining what is material information and what is not material information. We're very reliant upon them. The Sustainability Reference Group, that's a group of subject matter experts that the actual technical staff is able to sit down with and ask important questions about, okay, how does water management work in the hospitality industry? What are the air emissions of an industrial manufacturing plant? Being able to sit down with this group of about 150 subject matter experts, we can actually delve into the details to find out, okay, what is actually measurable, and is it a good proxy for material information? And then there's a list of a host of other advisory groups that we work with. Just in closing, the ISSB is striving and providing that leadership to converge this fractured landscape of reporting. And ideally, it'll benefit both the investor as well as the preparers out there in terms of cost effectiveness. But we do need your help. We need your input as we develop this next phase that we've already, of course, issued the climate-related disclosures as of last year, but we're looking beyond those to biodiversity, human capital, human rights, and we need your input. I would appreciate if you ever want to contact, whether it's myself or the ISSB in general, please contact our staff and let us know that you can provide us some input on basically the industry-specific issues that you face in terms of the risks and opportunities that you see. Thank you.
Yeah, also a very warm welcome. Good morning. Let's dive a little bit more into transition risk, as David was already discussing a bit the physical and transition risk part. Before we do that, let us just reflect if we are finding a significant risk for our industry. I think we should also make sure that we really reflect in terms of strategies and our targets, what that really means for our industry. Let me give you a brief, maybe personal example. You probably all know Spain. You have your operations in Spain, I'm sure. If you go to Costa Brava and if you buy, let's say, a 5 million villa at the Costa Brava overlooking the Mediterranean Sea, you will probably buy a multi-million-dollar villa that has artificial grass already in the garden because it's too expensive and sometimes not allowed anymore to water your garden in the summertime. You are not allowed to refill your pool. And I was thinking hard to buy, because I love the warm sea and the Mediterranean Sea, to buy a small boutique hotel there. And guess what? I finally bought one and operate one in Galicia, which is the very north of Spain. Actually, because I was also doing a lot of real estate work before, I bought it below construction cost. And I think from a strategic point of view, it was a good decision. But Mark, we should have met a year before because I need some more operational excellence and some more courses because I'm losing a lot of money at the moment. So be my guest if you ever come to Galicia. But let's talk about the risks. We did develop a software on physical climate risk for real estate already 10 years ago, sold it to the German government. I think in terms of research, we did what we could in that respect. And one of my PhDs was just lately looking at physical risk climate tools, which I'm sure all of you are also using because you want to assess your risk. And guess what? If we input data from a pan-European demo portfolio, all the same data for all the same tools, you end up, for instance, this location within these 10 to 15 tools with completely different results, right? So what does it help us? We need some alignment, and you were also both actually elaborating on global alignment. We need also alignment on methodologies, because in the end, we want to use these tools for our industry. We want to base our strategic decision-making on the results, and I think there's a lot more to do. But let's dive into transition risk. You were already talking about stranded risk and stranded assets, of course. I mean, let's face it, in the environment, in the economic environment we are working in at the moment, ESG is not anymore on the top priority point, on the number one spot of every board meeting. It's at the moment the complicated financial environment, I would say, at least in some countries. We are doing a lot of restructuring work at the moment. So it's the financials. And I think it's a fair question to ask whether or not, with all these roadmaps and energetic refurbishments we need to do, net zero commitments, pledges, and so on, can we afford that? Do we want to afford that? And are properties really worthless just because of transition risks? And of course, they are not worthless. If you have a super location, your guests will come anyway, whether or not you're blowing 1,000 kilowatt hours per square meter in a year in terms of energy consumption or not. Nobody will care, right? So it's just one strategic aspect, but the question is, of course, you were already mentioning this nasty word, woke or not woke. Can we and shall we do it? And I'm 100% convinced, no matter what is happening in the future, because climate change is sadly progressing, we need to have that on the top list of our agenda going forward, even though it might not be on the number one spot at the moment. So make sure you have your roadmaps. We are talking about operational implementation. Make sure you have that aligned to your normal CapEx spending, because in the end, it's not so much more expensive to ensure that you have an F-gas exit program in place, for instance, because that's also greenhouse gases. And make sure you have wise investments, right? Because in the end, it's of course not just having some additional energetic refurbishment budget, but having made wise investment decisions. Because obviously it's not just regulation, it's shareholder pressure, it's what investors are demanding. If you want to get money from Norges, if you want to get APG or PGGM as a core shareholder within your entity, then you have to make sure that you are addressing these topics, because otherwise you will lose money, because your tenants, your tourists will request that, your investors will request it, but it needs to be done in a wise way. CRREM is the global standard to decarbonize properties. It's the standard and decarbonization pathways to align to the Paris Accord with regard to 1.5 degree or 2 degree alignment. Actually, CRREM saw significant growth because we were, I guess, the first initiative that was focusing on use type specific and country specific decarbonization pathways for the industry when we initiated our project, because we thought, after looking a lot on at these topics of physical climate risk, sort of what is the next topic, and I think it's energy and carbon. And if you remember this first poll that we did at the very beginning, I think we were all clear that energy and carbon, in terms of the E of ESG, were at the center stage of all our attention. So it's important to look at these topics. What is CRREM, Carbon Real Estate Risk Assessment, doing? Well, we have these decarbonization pathways. When we started, there was just the SBTI pathway that was not differentiating whether or not you have a hotel in California or whether you have, I don't know, an office building in Singapore. It was sort of all the same decarbonization requirements. And I think we all agree it makes a huge difference what kind of use we are looking at, what kind of country we are operating in. So these are use type and regional-wise specific. And we do offer something for hospitality. We acknowledge together with UFI that, of course, we need some more granularity when it comes to hospitality and hotels, because obviously if you do the laundry in-house, for instance, it makes a completely or creates a completely different energy and carbon profile in contrast to organizations that outsource that service, just as an example. And that's why we need to get to a higher degree of accuracy and normalization. If you input your property data, you can basically forecast at what point in time you're currently potentially below market average consumption level is stranding, which means it would not be sufficient anymore and in line with market expectation and decarbonization requirements, because obviously regulation is progressing over time. The tool offers a lot of normalization for ongoing grid decarbonization, obviously, and climate normalization and other things. And then, of course, that is your carbon risk analysis. And this is, of course, also a tool that you could apply. It's a freeware tool. You can download it online, where you can simulate some energetic retrofit and sort of see whether it pays off financially, but also in terms of the embodied carbon that comes along with that energetic retrofit. When we started, obviously, I'm not a native UK citizen. We started in Germany, and we have, of course, a lot of industry bodies also in Germany. It's the Zentraler Immobilienausschuss, which is the very top level industry initiative, and they were saying we will never cease when we will never see the carbon taxation in Germany. And I was like, yeah, might be the case, but let's be prepared. Right? Now we have for every property, also besides the European requirements, also national requirement for energy and carbon pricing, compulsory in Germany, and that's why everybody is sort of happy that they were, if they were prepared in using our tool to introduce some internal or shadow carbon pricing already before. And that, of course, needs to be aligned. We heard it before. We were trying to align with all the relevant players, and this is just an extraction of the alignments and MOUs we have in place. Because let's face it, we are running out of time, right? We can't afford to have, again, 50 different certifications in every country, like we have it for some other property-related ESG topics. So we need to have some global alignment to decarbonize our properties. We are already covering approximately 20% of the global institutional property stock. A lot of activities at the moment in the US, a lot of activities in also Asia-Pacific. India and China, you were also mentioning China before. China is for us still a hard one to access, but I guess it's the same for many organizations that are trying to get to a stage where you have global alignment. What should we do as an industry? we are talking about operational measures today. I think you should not start with procuring green energy. That should be the last step. Thinking hard about energetic retrofits. Again, if you have a 5-star hotel consuming 1,000 kilowatt per square meter and year, you should start about thinking about energy efficiency, right? And then, of course, on-site renewables. We did a study with United Nations last year, and guess what was the percentage of all these super-duper properties that were supplied by global investors to do the assessment? They were all certified. What was the on-site renewable energy production available for the consumption? It was just 1%. And that's, of course, not enough. We shouldn't just cover 1% of our consumption with on-site energy production. So there's a lot more to do on that one. And then, of course, consumer behavior, which is a big topic also for hospitality industry. And then sort of the ultimate step is procuring green electricity. Now, if we all aim for net zero, I think that is also something we should question, right, in the light of maybe some, at least, not so fast progressing regulation, which we might see in terms of a more complicated economic environment going forward. I think it's just a fair question if you want to align to really net zero, or if you want to align your property or make your company fit for, let's say, 2 degrees. And we do have some market participants that are actually at the moment openly saying, okay, 2-degree alignment is for us enough, because we might not see a 1.5-degree regulation going forward. And then again, getting things right. Colleagues from the financial reporting side, you would never in your balance sheet state an approximate amount of your CEO's remuneration, right? It would be the right amount in terms of the very last pound you will pay him or her. And I think we should be clear that also for financial, for sustainability disclosure and reporting, we need to have the same accuracy. We have just been publishing an alignment and large global consultation also with PCAF and GRESB document on carbon counting, because it's a complex topic. You were already seeing scope 1, 2, and 3, and a lot of market participants still do not get it right. I think the reason for that is that a lot of the market participants that have, for the last 2 years, ESG on their business card weren't in that business before. So we really have to focus on education and harmonization going forward. And that's the reason why also EEA and CREM are going to collaborate on more precise standards and guidance for the hospitality sector. Thank you very much.
Great. We started a few minutes late, so we do have a couple of minutes for questions under Mark's control. Brilliant. Okay. If you have a question, please put your hand up. I mean, I have one for each. Maybe I'll kick off myself, and then if you have questions on the screen. Oh, okay, brilliant. Why don't we start with that? So the question on the screen is, stranded has become a very controversial word. Is there a better way to articulate the point of inflection? Maybe that's one for you, Sven.
I completely understand where you're coming from with that question. I would say, since it's controversial, it couldn't have been chosen better, right? Because I think we really made the industry think hard about this. And when I started, I was already trying to at least catch that discussion a little bit, because of course, we should be clear that transition risk is one topic of many that is influencing values. And if we talk about stranded assets in the context of transition risk, it's of course just this one topic, and it doesn't mean that your property is worthless. That was never the intention. There's a precise definition also of transition risk, which is, I think, universal applied, not just within our industry. And so yes, it's a bit controversial, but I think it's good to have that phrase.
Lovely. You had your hand up as well. I'm not sure if there are mics, but you could just call out. Yeah?
I'll share one. Very interesting, Sven. Thank you very much. In terms of the CREM pathway, sort of stabilises flatlines in 2037, certainly for UK. I'm not sure whether that's the same for the rest of the world. Do you anticipate there being a magic pill that we can all go and buy in 2037? Flatlines of about 1995. Is that correct?
You are addressing the point that the energy curves are sort of flattening out. The CO2 curves are sort of decarbonizing to more or less zero. That's why it's 1.5 degree aligned. And the energy curves are flattening out because in the end, if you look at the consumption level, of course, we will have some energy consumption also going forward for our properties. And there has been an EEA-aligned allocation of the available renewable energy budget for 2050. And the amount that our industry as a whole, real estate industry, could consume. And there's, of course, within that also an allocation which is sort of allocated a bit up and down for the different use types. And that's why it's flattening out. It's flattening out in all countries, but not at the same point in time. And once sort of the recalculation of the CO2 curve into energy is hitting that point, then it flattens basically out, because we say, okay, if you have that, we always have these two strategic issues, right? You need to think hard about your energy intensity, but at the same time, you also need to make sure that your carbon intensity is going down. So it's not just one or the other thing, it's both topics, because obviously both are sort of creating risks for your entity.
Maybe one for Eureka. Yes.
I have a question just related to that. So there's two ways to gauge whether the asset is stranded. One is on the energy use intensity, the overall consumption, and the other one is looking at GHG. What if it's stranded from an EUI perspective and it's not from a GHG perspective, which is what we're seeing quite a bit of in hotels, because overall, obviously, they consume a lot of energy. What's your take on that?
So your point is it's stranded in terms of the energy intensity, but it's not stranded in terms of the carbon intensity. Mm-hmm. So obviously you are running already electrified properties, sort of, because they are not emitting CO2. I'm just, to understand your point. I think in the end we need to acknowledge. It's just you can tick the box for one topic, right? But I think in the end also we need to make sure that energy-wise our properties are attractive, because in the end it's also, of course, if you do not have high occupancies, it could cause some pain, right? Because if energy prices are snoring upwards, or you might have some restrictions also from the regulatory side on the energy use, which could be also a reason why you need to cut down, then of course this also could still create problems, right?
Maybe a final one for Corey. Could you say something? I guess there are people in the audience who run businesses of lots of different sizes.
Right.
Could you say something about, who do you envisage these standards applying to? Obviously, the larger firms globally, but how is this envisaged from an IFRS perspective? I know you're also setting.
We tend to be fairly agnostic in terms of capital. Basically the size of a company in terms of how we develop our standards. However, we recognize that larger companies have a larger back office staff that can deal with it. They may have bigger resources to basically rely upon. What we've seen in terms of the jurisdictions actually applying our standards, typically they're basically doing a staggering approach where they'll take the large cap companies first, and then there'll be another tranche of the mid cap, and then a next tranche of the small cap after that, simply to develop those best practices within the jurisdiction and to provide an example to subsequent lower capitalized companies as they go. That's perfectly valid form of transition. Also, we see just in terms of voluntary adoption, it's what we find typically is that although the larger cap companies may have already been reporting to sustainability related disclosures, some of the smaller companies may be able to actually assess their risks and opportunities quite effectively on a voluntary basis. Yeah. But in terms of our encouragement of the jurisdictions, there typically is a stair-step approach, and again within IFRS S1 and S2, there's a concept of reasonable, supportable information. So, for instance, in IFRS S2, there's a request for the preparer to develop scenario analysis. Perhaps your company doesn't even know what scenario analysis is, and they've never used it. Larger companies have been using scenario analysis for years. But if you can't use scenario analysis, if it's a tool that you're not familiar with, you can provide basic heuristics around what you estimate will happen in the future based on your investments or the increase in your expenses, et cetera, what impact that'll have on the financial statements themselves. So there's a proportionality in terms of the amount, the expectation of how much information you should provide depending on how mature your company is.
Lovely. Let's stop there in the interest of time. So thank you very much indeed.